On the thought leadership front, speaking of our YouTube channels, we do have a geopolitical roundtable led by Bill Campbell, Valerie Ho, and Jeffrey Sherman. Then also we have our very own Ken Shinoda with Channel 11. So go to our YouTube channels to view those or listen to those. And then we have two webcasts, the Sherman Show podcast, widely acclaimed, and the Monday Morning Minutes with with Sam Lau and Jeff Mayberry. Both of those are available on DoubleLine.com, iTunes, SoundCloud, Google Podcasts, Spotify, and Stitcher. So without further delay, I'll turn the webcast over to Andrew Hsu.
Thanks a lot, Ron. So when we were coming up with a title for this webcast, we were looking at the economic landscape and then looked at infrastructure sectors through cycles. And we did reflect that challenging economic environments are truly when infrastructure assets really shine. Now, COVID was impactful in a way like no other recession has ever impacted infrastructure. Obviously, global societies, they can't shut down for long, and soon enough, with the spark of human activity, this led to a strong rebound in growth and correspondingly with utilization rates in infrastructure assets. Now, we're facing new macroeconomic challenges today, but we're also confident that infrastructure will fare well. And in many ways, new opportunities will be born from some of these challenges. So here, we're laying out some of the key issues concerning investors today. And while some of these do pose challenges to the macro markets, the characteristics of infrastructure assets, they may dampen some of these risks and, again, could even provide some new opportunities. First off, on the top left, geopolitical issues. They have put strains on food stability, data safety, energy security. And this puts increased reliance on our existing infrastructure. We do see CapEx growth in energy infrastructure as key for national security. And then moving to the right here, the Fed is meeting tomorrow, and the expectation is for a 75 basis point rate hike. Tackling high inflation is the #1 agenda item for central banks globally. And while higher inflation has eroded everyday spending power, increases in commodity prices make it even more viable for infrastructure projects that break ground, and in some cases even be more profitable. Efforts to stem inflation do lead to concerns about hard landing or even a recession. And here, this is where the inelastic demand for infrastructure assets will prove helpful in mitigating some of the impacts of slowing economy. We do see hard assets as a defensive investment during these hard times. Finally, with climate change, this has been something that's been brought up by many of our investors and has been certainly a hot topic in the broader investment community. But the adoption of ESG standards are indicating investors are keen to support companies that are making an effort to curb their carbon footprints, and also putting a focus on other issues such as social and governance standards. Now, this has driven dollars into areas such as clean energy, and we do see this as a continuing incentive to build out renewable energy into the future. So we did talk about energy security. This is a focus for every country. And here we're seeing global oil inventories last year, and we're comparing them to 2022. Lack of adequate CapEx has put producers in a compromising position to meet the spike in demand post-COVID. And this is causing a draw on reserves. Geopolitics, they're further exacerbating some of the issues here. And European nations are returning to coal just to meet energy demands. And countries like the United States are exporting more energy to help bridge the supply void. What we're seeing is the creation of an entirely new energy system. And this would reduce the dependency on traditional suppliers such as Russia, and then also increase uptake from countries like the United States that have transitioned into net energy exporters. The result would be pretty significant infrastructure spend, but we do see it as ultimately creating more resilient energy supply source, and eventually this will reduce costs to the end consumer, both domestically here in the U.S. and abroad. Next, we're taking a look at natural gas storage in Germany, and this is really a proxy of what reserves look like across Europe. There are really two takeaways from this chart. Firstly, if you look at the blue line, this represents 2022. The absolute level, it doesn't look extremely low, especially when you compare it to some of the previous years. What's important to understand here is that in years where reserves were lower, the power mix relied much less on natural gas, and there were alternatives such as coal or nuclear sources. And this is really in the case of 2017 and 2018. In 2021, we did see massive demand in the wake of the COVID doldrums, or coming out of the COVID doldrums, and this drew heavily on reserves. Now, 2022 is slightly different in that we see lower levels, but it's a much larger problem now, given that Europe's power mix is heavily reliant on natural gas. So the second takeaway is what we're seeing in the second quarter of this year. Europe has started to build reserves, and they've started mandating power conservation, but also increasingly imported LNG from the United States. This has been really taxing on the existing infrastructure, and we are seeing very high utilization rates, and it's critical that we make sure that this infrastructure stays online and operational, because the number one priority right now is to get through winter. Europe needs to increase reserves to get through winter, but we do think that post-winter, this existing infrastructure will be heavily relied upon, and new infrastructure will have to be built to support some of these new energy systems. Self-sufficiency, it's become the main goal for many countries, and in the area of energy security, renewable energy has become the tool to help countries take steps to achieve this. Now, what we see here, there are two bar charts. The first bar chart on the top shows the power mix in the European Union, and it shows LNG diversification as being the immediate priority. This means shifting away from traditional sources to new suppliers for natural gas. This requires significant infrastructure spend both here in the United States and in Europe to ensure storage, transmission, distribution, and other facilities to transport these hydrocarbons and to make sure they get utilized efficiently. Now, over the longer term, this is referencing the lower bar chart now. Renewable energy will be the key source to make this happen. And again, this will require tremendous investment in infrastructure, and we do see this as a very large opportunity for further build out in renewable capacity on a go-forward basis. To graphically quantify what's happening in the energy space, here we see U.S. LNG exports to various regions. China's economy is still idling due to COVID lockdowns. So excess natural gas that was being shipped to them previously is now being shipped to Europe to address their shortfall due to Russia's curbing of nat gas exports. Now, if you compare this to previous years, the growth in nat gas exports is double what it has historically been. And this is expected to double again within the next 6 years. So the U.S. has very much moved from a gas importer or energy importer to very much a gas exporter. And I think this will continue to be the case, further increasing the need for infrastructure build out and increasing the use of existing infrastructure in this space. Okay, clearly with energy security, this is paramount globally, and we do see CapEx trends in the past and into the future on this chart. Within traditional fossil fuel energy, there's going to be continued CapEx spend. We can't rely on renewables solely. And with underinvestment, really since 2017, we do have some catch up to do. And we can see that this is producing some significant opportunities across various forms of hydrocarbons in the future. We have several positions in the portfolio already, and these all benefit from long-term contracts, and they are offtake. Their offtakes are with investment grade rated or state-sponsored companies. So exceptionally secure and very stable cash flows. Very attractive investments in our opinion. Shifting gears and looking at the transport sectors, here we see shipping volumes over time, and what's going to be surprising to many of the listeners are that port congestion is worse now than it is during COVID. So you can see this on this chart. Disruption in supply chains, they've driven prices higher, they've extended delivery timelines. This is all inflationary. So immediately, if you look at infrastructure assets in the space, they are performing well. You're seeing high utilization rates, you're seeing higher lease rates, and these are all passed through to the end consumer. Over the longer term, we do view it as critically important that additional projects are taken to modernize port efficiency. Clearly, what we saw during COVID was damaging to the overall economy, and we're still facing these issues today with very high inflation. But we do think that increased or improved infrastructure will help alleviate pressures on a go-forward basis. So infrastructure does tend to have strong performance even during periods of economic slowdown. But with this chart, you can see that transport infrastructure, it was severely impacted during COVID. As manufacturing shut down during the initial outbreak, supply chains essentially all seized up. Now, if we look at the blue line, we do see rail traffic fall sharply during the first quarter of 2020, but it quickly turned around and rebounded back to normalized levels. Now, rail infrastructure delivers everything from durable goods to food to energy, and despite the brief but very severe drawdown, we are seeing volumes come back. And again, very critical here in terms of a well-functioning economy. So you do see things bouncing back very quickly. So another area of transport that displayed a similar pattern is aviation. Global lockdowns, as they took place in 2020, passenger revenue fell substantially. But if you look at 2022, we can see revenues approach pre-COVID levels. We've already talked about this, but the environment is definitely facing some elevated inflation. And aviation mobility figures have been very strong despite this. And they do seem to support the notion that infrastructure assets have some elements of inelastic demand. So here you see passenger revenues bounce right back up, and cargo revenues are starting to actually steadily increase as you continue to see congestion in ports. So very strong performance on the aviation side, and clearly inelastic demand, even as higher prices are in place, you see mobility numbers up. Okay, back on the topic of energy security, but really kind of maybe a different derivative of it. There's been a strong push to establish energy security while doing so in a sustainable manner. So it's become much easier to do this as technology advances, and you're starting to see wider adoption of renewables and making it renewable energy more efficient and even cheaper to produce. So on this slide here, what we're looking at is the levelized cost of electricity between various forms of power over time. And we can see that the cost of wind and solar power have fallen sharply, and it's making it a lot more cost effective than nuclear and coal. But this is pretty interesting, is that it's also cheaper than natural gas, which is the predominant source of power today. What's important to note here is that the chart does not give credit to tax incentives or subsidies. So without any of these artificial support measures, renewables are still competitive compared to traditional means of power. We really focus on this area, and we've seen about 70% growth in this industry over the last 5 years. You really did not see any slowdown within this space, really just demonstrating the resiliency here. Okay, this is the final slide for me, but on this chart, what we're comparing here is a power mix in the U.S. between two time periods, 2010 and 2011. With the shale revolution and more recent focus towards cleaner power, we've seen coal-fired power drop by more than half, while natural gas and renewables have filled that void. As technology improves, renewables are getting cheaper, and if you couple this with battery storage, we now have renewables as around-the-clock power source. So we do see a number of exciting opportunities within the infrastructure space. We do see it as very defensive with many attributes that prove to be inelastic and resilient during crises. So we do believe that also these become more compelling as we navigate these latest business cycles.